Chapter 2 shows why the professional investing world often works against finding the biggest wins, and why that gives ordinary investors an advantage. Peter Lynch calls many Wall Street practices oxymorons, the rules, customs, and incentives that make professional investors behave in ways that seem sensible for career managers but are terrible for spotting the next 10-bagger. Start with the idea of street lag. Big institutions and sell-side analysts move slowly. A small, fast-growing company can be obvious to customers and local shoppers long before it appears on an analyst's radar. Lynch uses the limited as a classic example. The stores were packed, expansion obvious, and customers could see the story in their malls for years, yet only a few analysts covered the stock for a very long time. By the time Wall Street piled in, the share price had already soared. That delay, the lag between what everyday people see and what institutions finally accept, creates opportunities for individual investors who pay attention to the world around them. Lynch then explains the many practical barriers that keep professionals from acting early. Fund managers are hemmed in by regulations and formal limits. For example, mutual funds cannot own more than a certain percentage of one company, and many funds have market cap minimums. Those rules make it hard or impossible for large funds to buy meaningful positions in small, fast-growing companies when those companies are at bargain prices. Internal controls and pre-approved lists. Pension funds and insurance companies often invest only from a restricted menu to avoid diverse performance complaints from clients. The effect: managers choose safe, crowd-approved stocks, which tends to produce mediocre, uniform results. Career risk and oversight: fund managers must explain every pick to bosses and big clients every quarter. Buying an oddball company that later falters is far more likely to get you fired than owning a blue chip that falls. So the comfortable conservative choice, IBM, Xerox, Sears, is often preferred over a quirky, high-potential business. Size: the larger the fund, the harder it is to generate big percentage gains. Buying or selling large blocks moves the market and takes a long time, so big funds avoid small caps even when they're bargains. Lynch describes how these constraints lead to groupthink. Managers copy one another, buy what other big funds own, and avoid being the first to take a stand on a weird but promising company. Worse, when a contrarian choice looks bad on paper, managers are quick to bury the evidence by selling it so the portfolio looks conservative and uncontroversial in the next review. Lynch stresses that the professional world is not uniformly bad. He praises mavericks like John Templeton, Michael Price, and of course Warren Buffett. But those exceptions are rare. For the most part, the system rewards playing it safe rather than discovering the unusual opportunities that create massive returns. That's the key takeaway. Amateurs have real structural advantages. You can move fast, buy small companies before they become crowded, and act on local knowledge. What you see in stores, restaurants, or in your own workplace. You don't need committee approval or to answer to a nervous pension manager. You can own a handful of stocks you truly understand, and you can add to winners or trim losers without risking your career. Practical lessons Lynch pulls from this chapter. Look where the pros aren't looking. Find everyday signs of growing demand before Wall Street does. Be willing to act early on small, out-of-favor, or obscure companies, but do your homework. Not every local hit is a durable business. Don't confuse the presence of many analysts with safety. By the time dozens of analysts cover a stock, the potential upside has often been priced in. Embrace independence. A small investor's freedom is a strategic asset. Use it. In plain language, Chapter 2 says, the market is full of built-in constraints and herd behavior that work against finding big winners. If you pay attention to what you and the people around you already know, and if you're willing to do the simple research most professionals avoid early on, you can turn that street lag into your advantage. Be amateurish in the best sense, curious, local, and unconstrained, and you'll find opportunities the professionals miss.